Hey guys, welcome back to the IGCSE Accountant. In today's video, we're going to be looking into something different. I hope you all checked out my previous video on the difference between bookkeeping and accounting, and we also explored a few other information about what bookkeepers do, what accountants do. In today's video, we're going to go a little in depth into that. So first, let's talk about profit and loss. So when does a business make a profit and when does a business make a loss? So this is a very important thing that every student should know, because this is the basics of accounting. So if you're learning accounting, you should know how a business makes a profit and how a business makes a loss. So firstly, profit. When does a business make a profit? So businesses make income and they pay expenses. This is something that's very basic. Okay, so when the income is greater than the expense is when a profit is made. For example, I make a income of $5,000. Just note that all the currency that we have in accounting is always dollars. So for example, I make an income of 5,000 and I have an expense of $2,000. So in this case, how will you know the profit? 5,000 minus 2,000. And also remember, we do not have minus in accounting. Anything that is enclosed within brackets is meant to be subtracted. So 5,000 minus 2,000 is $3,000. Okay. However, in case of a loss, it is when the expense is greater than the income. Let's take an example. For example, the income you make is $10,000 in this case. Okay, and the expense you have is $12,000. So in this case, you cannot calculate your profit because it's a loss. You'll get a negative answer, but you're not supposed to write minus 2,000. Okay, it is completely wrong. What do you have to do? You have to enclose it within brackets. You have to write $2,000 loss and write loss here. Okay, so this is what happens. So now you've got the basic. Profit is when income is more than expense, and loss is when expense is more than income. But you may be wondering, why is it important to measure profit or loss? So usually when businesses start, the owner is referred to as an entrepreneur because they have an idea to start a business and they invest an amount into the business. This is usually called capital, but we'll look into that later. So when businesses and owners invest money into their business, they are taking a risk because they do not know if the business is going to make a profit or if it's going to make a loss. Owners will not know if the business is going to make a profit or loss. So obviously they're taking a risk. So in this case, when a business makes a profit, it is a reward for the entrepreneur. This is very simple. So when a business makes a profit, it is a reward for the entrepreneur. Okay? So now, how does a owner or entrepreneur know if their business is making a profit or a loss? So this is where the role of an accountant comes into picture. So we already learned that accountant is the one who prepares financial statements. So these financial statements show the profit. And this one is used by the owner to make decisions. So you may be wondering, what kind of financial statements does an accountant prepare? So usually for now, let's just look into two types of financial statements, basic financial statements that are very easy to prepare and we will be learning in the next upcoming chapters. But let me just introduce you guys to those. The first one is income statement. And the second one is statement of financial position. Okay, so an income statement shows the profit of the business, and the statement of financial position shows the assets, liabilities, and capital. So we will look into the preparation of these financial statements in the later chapters, but let's just know that this is used to calculate the profit of the business, and this shows the assets, liabilities, and capital. So now you may be wondering, we know what profit is because we already learned what profit is, but now we've got introduced to 3 new terms. Let's put them down here. Assets, liabilities, and capital. So what are assets? Assets are anything that is owned by the business. And what are liabilities? Anything that the business owes. It can even be to a supplier or some other business. Okay? Now what is capital? It is the amount invested by the owner. We came across this term when we were exploring this part. So entrepreneurs do take the risk of investing an amount. That amount is called capital. When they invest something, it's called capital. They take the risk of investing capital into the business, and the reward they get is profit. Let's get back to these. So these are 3 important terms that we will be using fully in all the chapters. So now we do have different types of assets, different types of capital, so different types of liabilities, and we have capital. So assets, we do have 2 types. One is non-current and second one is current. Next we have liabilities. We have non-current and current. Okay, so we know that assets are anything that is owned by the business. Liabilities is anything that the business owes. So the business is liable to pay someone else. It can be a supplier, it can be a customer, or even some other business. And capital is the amount invested. So we have to make sure to identify the difference between owned and owes. It's very important. Okay, now let's get back to assets. So firstly, let me give you some examples of assets. So these can include machinery, they can include money in bank, it can include cash or inventory. Inventory is nothing but a stock of goods that the business sells. Okay, or it can even be land or building or equipment. Okay, so let's move on to. So now we have to classify which of these are non-current assets and which of these are current assets. So now let's see the difference between non-current assets and current assets. So non-current assets are assets they are long-term assets. Let me just give you a proper definition. They are long-term assets that the business intends to own for more than a year. So the point that you have to emphasize when writing these kind of answers, if asked in MCQ or theory questions, is it is owned for more than a year. But when it comes to current assets, they are used up in less than a year. It's very important to emphasize on this. Okay, so now let's move on to non-current liabilities. So these non-current liabilities are also long-term liabilities. So for example, you may have heard your parents talking about having to pay interest on loans. So most cases people do take non-current liabilities because these can include loans like that are paid back for more than a year. Next is we do have current liabilities. These are short-term liabilities. For example, we do buy a lot of stuff on credit. We do have options like EMI. So all of those are paid back within a year. So this can include EMI, or some people also use a bank overdraft. So overdraft is when, for example, you have to pay some money to me, and you only have $100 in your account, but you have to pay me $200. So for that $100, you can take an overdraft. You can send the money to me, and you can slowly pay back the overdraft by paying interest to the bank. So this is bank overdraft. Okay, so next, let's move on to capital. We have seen the difference between assets and liabilities. Now, Let's move on to capital. So we already know that it is the amount invested into the business by the owner. So capital is any resource provided by the owner to start a business. So capital is often in the form of money, or it can even be, for example, a building. Even though buildings are examples of assets, they can be in the form of assets. Capital can be in the form of assets, but it's usually for the business. Okay, so if a business makes a profit, the capital also increases. If a business makes a loss, capital also decreases. Now we're also going to be introduced to something called, so that is it with capital. Capital is very simple. It is just the amount that is invested by the owner into the business. Now we're going to be getting introduced to a term called drawings. So drawings is a very important term in accounting. Drawings refer to when an owner takes assets from the business for their personal use. For example, you have a business that sells soaps, handmade soaps. Obviously, you want a soap for yourself. You're taking something. It means it's called drawings, because you're going to have it for your personal use. However, if you're going to be taking that soap and you're going to be keeping it in your office for your employees to use, it is not drawings. So drawings refers to when an owner takes assets from the business for their personal use. So personal use is a very, very, very important term to remember. Next, after this, we have something that is very, very important. It is called the accounting equation. So far, let's just take a quick revision of what we've learned. We've learned in today's class about profit, we've learned about loss, we've learned about when a business makes a profit, when a business makes a loss. Profit is the reward for an owner for investing capital into the business, and what accountants do, how accountants help the owner to make decisions in the business. What do the accountants prepare and give to the owner to make better decisions, which is the income statement and the statement of financial position. Income statement shows the profit for the business, and statement of financial position shows the assets, liabilities, and capital. We did learn about what are assets, what is liabilities, and what is capital. Assets is anything that is owned by the business. Liabilities is anything that the business owes to some other business or supplier or customer. And capital is the amount invested by the owner. We also saw a few examples for assets that is put up over here. They are machinery, money in bank, cash, inventory. Inventory is basically stock of goods that the business sells. For example, if you're selling handmade soaps again, you will have to make a batch of soaps and store it so that you can meet the customer demand. If customers order your soaps, you'll have to give it to them. You won't have time to sit and make soaps and then send it. If you have a shop, you have to give it immediately. So in that case, anything that you have, even if you go to a store, for example, you're going to a supermarket, all the stuff that they have there that is available for you to buy, it's called inventory in accounting terms. And other examples of assets include land, building, and equipment. And we also saw the different kinds of assets. The first type of asset is non-current assets, and the second type is current assets. Non-current assets are any long-term assets that the business intends to own for more than a year. For example, businesses don't buy new machinery every year. They just keep the machinery unless after it wears out and the machinery is not able to produce productively as much as it used to. That is when the businesses change the machinery. Until then, that is what they use. So that is a long-term non-current asset. Current asset is they are used up in less than a year. Now let's just quickly classify out of these examples which is a non-current asset and current asset, and we should also see the reasons why they are classified so machinery, it can be used for many years until and unless it wears out. You can use the machinery. So I'm just going to write NCA. Money in bank, usually businesses classify money in bank as a current asset because they do have day-to-day expenses in the business. For example, fuel costs, delivery costs, buying from supplier, giving daily wages to certain employees who work just for a few hours. So it is a current asset. Next is cash. Cash can also be spent quickly, so it is considered to be a current asset. Inventory, it is usually sold in less than a year, so that is also a current asset. Land is a non-current asset because it can be owned by the business for more than a year. Buildings is also a non-current asset because it can be used for more than a year. Equipment is more or less the same as machineries, that is also a non-current asset. And then we also saw about drawings, which refers to an owner taking the assets from the business for their personal use. So now let's move on to the first concept that we're going to be learning. So far, all that we saw was just small examples of profit, loss, different definitions and different terms. Now we are going to be entering a main concept, accounting equation. So we all have learned different equations in math. So equation usually has a right side and a left side, and it is equal to both are equal. So same way here, since we learned about assets, liabilities and capital, we do have an accounting equation where assets of a business is equal to its liabilities plus capital. Assets is equal to liabilities plus capital. So the formula for the equation states that the assets of the business are always equal to the liabilities and capital of the business. You can rearrange this equation so that you can find one of these three values if the other two are known. For example, in some MCQ questions, you will be given different assets and you will be asked for something. So in that case, you have to make sure that you have two values. You'll either be given with assets and liabilities and you have to find out capital, or you'll vice versa. Any of those two information will be given. So you have to rearrange this equation. An easy way to remember all three equations when all three are asked in different questions is that when liabilities are asked to be found, always assets is in the front. The same thing minus the capital. When capital is asked, you put assets in the front minus the liabilities. But don't forget that the original accounting equation to find the assets is plus, and to find the liabilities it's minus, to find capital it's minus. So don't get confused. Moving on, so you may be given examples of assets and liabilities and asked to calculate the missing figure for capital in most questions that appear on paper 1. So this is a tip that you can note down. So why is the accounting equation important? So the accounting equation is what is shown in the statement of financial position. So if you know this equation, you can simply just create a statement of financial position. So it's very easy. If you know what are non-current assets, what are current assets, what is non-current liabilities, what is current liabilities, what is capital, you will easily be able to create a statement of financial position. So the statement of financial position will be affected every time the business makes changes to the assets, liabilities, and capital. So every single transaction will result in at least two changes which balance out. Both sides of the equation can increase by the same amount, both sides of the equation can decrease by the same amount, or even both sides of the equation can stay the same. So this is the end of the first chapter, which is fundamentals of accounting. I hope you guys understood this chapter. If you have any clarifications, please feel free to put up a comment, or you can just reach out to me on my email address. See you in the next video. Bye.